Capital allowances in the UK are an important aspect of the tax system, offering tax relief for businesses on their purchases of certain assets. These allowances enable businesses to reduce their taxable profits by deducting the cost of qualifying assets and thereby lowering the overall tax liability. Here's a basic breakdown of the concept and various components of capital allowances. A simple definition and purpose. Capital allowances are deductions that businesses can claim for use of assets such as plant and machinery, vehicles, equipment, fixtures, fittings, so on and so forth. The primary goal is to encourage investment by allowing businesses to write off the cost of assets over a certain time period against their taxable income. Qualifying assets for capital allowances. Plant and machinery. This includes items that a business uses on a regular basis, such as machinery, office equipment, fixtures and fittings, so on and so forth, and it can also of course include cars. Exclusions. Items that do not qualify for plant and machinery allowances include leased items, items used for business entertainment, buildings and structures, although there is a building and structure allowance, so those types of items you can't claim capital allowances on. Integral features and fixtures. Integral features, these are essential parts of a building like lifts, escalators, heating systems and electrical systems. Fixtures. Businesses can claim for fixtures and fittings like fitted kitchens, bathroom suites, fire alarms, CCTV systems, so on and so forth. The list is pretty long. The person claiming capital allowances must be the purchaser of all those items, or they should have a long lease and then they should have incurred the expenditure. Types of capital allowances. Writing down allowances. This allows a percentage of the value of an asset to be deducted from profits annually if you so choose. It's up to you how you do that, as long as you stay within the permitted range. Annual investment allowance. This allows a business to deduct the entire cost of an asset from their profit up to the specified AIA limit per year. At the moment it's £1 million, so it's quite significant. First year allowance. This includes 100% first year allowance for certain new and unused equipment, and temporary allowances like the super deduction and special rate allowance. Rates and pools. The main pool, which allows 18% relief for most plant and machinery and equipment, and you don't have to claim 80%, you can claim 17, 16, 15, whatever number you want. 18 is the maximum. Then you have the special rate pool, and this gives you 6% relief for integral features, items with a long life and certain vehicles. You then have what's called a single asset pool for specific assets that have a short life or are used outside a business. Special considerations. Residential property. Capital allowances claims are limited for items used in residential property unless they are part of furnished holiday lets, and even then for residential properties, for HMOs, you can claim for certain common communal areas and nothing else. So most residential property or single buy-to-lets, no capital allowances whatsoever. Service accommodation, yes you can. Value of an item. Usually the purchase price is obviously used and that depends how much you paid for it. However, market value is considered if the item was owned before being used in a business or was received as a gift. The claiming process. Documentation and agreements are important. It's essential to agree on the value of fixtures and fittings when you're buying something from a seller, i.e. you're buying a commercial building and you want to work out the capital allowances on purchase. Also, informing HMRC about certain claims like short life asset pools is necessary. You then have balancing charges and allowances. When selling an asset or closing a business, there might be balancing charges or allowances to consider, and this is why you've got to balance out how much you claim every single year, especially if you know you're going to sell your business. Exclusions and limitations. Non-qualifying items for annual investment allowance. Business cars, items used before business and gifts. If an asset is used outside a business, the claim amount is reduced accordingly. In summary, capital allowances are a fantastic relief and can help you immensely in your business, both in terms of growing your business and reducing your tax liability, therefore improving your cash flow. And it's important that you get it right, especially if you're doing service accommodation, for example. There are lots of items you can claim for, especially on purchase, and then obviously when you carry out the refurb. So it's important that you understand the type of assets that qualify, the different rates, and how the claim is obviously going to be handled by your accountant or tax advisor. And obviously tax planning and compliance forms part of that, and having a pre-year meeting to discuss what you can claim and how you're going to reduce your tax liability is extremely important.